trading right around the $3.35 to $3.40 range on heavy volume across the NASDAQ and the Toronto Stock Exchange. Keel Infrastructure Corp., Keel, presents a textbook case of market schizophrenia. To the casual retail investor scrolling through modern trading apps or financial social media forums, Keel looks like a struggling small-cap residual, heavily anchored to its historical identity as a legacy Bitcoin mining operation. Wall Street's surface-level algorithmic scanners still treat it through the narrow lens of cryptocurrency volatility, pricing it down as a speculative token proxy caught in the crosswinds of digital asset corrections. But that conventional label is not just outdated, it is a massive structural mispricing hiding one of the most critical power and high-performance computing land grabs in North America. What the mainstream financial media completely misses is that the entire narrative of artificial intelligence and high-performance computing has run headfirst into a physical bottleneck that no amount of software optimization or architectural wizardry can bypass: the brutal, unyielding reality of grid physics and power interconnection queues. While retail traders obsess over next-generation neural network weights and software benchmarks, the real gatekeepers of the AI revolution are not writing code. They are sitting on localized, secured megawatts and brownfield energy assets with pre-existing high-capacity grid interconnects. Keel Infrastructure Corp. is no longer just a crypto miner. Through a complete corporate metamorphosis, shedding its old skin as Bitfarms, re-domiciling to the United States, and officially rebranding, Keel has repositioned itself as a premier digital infrastructure and energy landlord. With a massive development pipeline scaling up toward 2.2 gigawatts and established highly coveted grid interconnections located squarely in high-demand power markets across Pennsylvania, Washington, and Quebec, Keel controls the exact scarce resource that mega-cap hyperscalers are desperately starving for. While public perception remains tethered to old crypto cycles, institutional smart money understands that owning secured megawatts with ready-to-deploy physical footprints is the ultimate moat of the modern compute era. Market dynamics and institutional positioning. Beneath the seemingly quiet daily price action of Keel lies a fascinating tug-of-war between short-term retail impatience and patient, long-horizon institutional accumulation. Daily trading volumes regularly spike as macro jitters over power grid regulations, interest rate trajectories, and energy caps sweep through the small-cap infrastructure sector. Every time regulatory headlines or short-term crypto pullbacks trigger a wave of weak hands capitulation among retail traders on modern trading platforms, institutional heavyweights step in to quietly absorb blocks of shares. They are not looking at next quarter's marginal hash rates. They are valuing Keel's assets on a dollar per megawatt replacement cost basis that towers over the current enterprise value. The structural transition from proof-of-work mining to high-performance AI hosting requires substantial upfront capital expenditure, which naturally depresses near-term GAAP earnings and creates volatile quarterly prints that scare away momentum chasers. Yet this very dynamic creates a classic mispricing window. Institutions are capitalizing on the market's inability to price a transitional asset correctly, scooping up shares while the broader crowd dismisses the stock as a low-margin commodity play. Think about your own portfolio positioning right now. Are you tracking the micro movements of daily crypto volatility, or are you positioning yourself ahead of the structural power crunch that will define enterprise technology for the next decade? Let us know in the comments whether you are accumulating Keel shares during these macro pullbacks or waiting for confirmation on their massive multi-gigawatt build-out. Business model and historical context. To understand why Keel Infrastructure is uniquely positioned today, we have to look past its historical framing as a pure-play cryptocurrency mining outfit founded back in 2017. Historically, the company operated as a standard digital asset miner, acquiring low-cost hydroelectric power in Quebec and scaling up operations to chase block rewards. While that historical cycle provided the company with deep operational expertise in managing massive electrical loads, high-density cooling, and continuous power uptime, it also trapped the company's valuation in the cyclical, highly punitive multiple of crypto beta. Management recognized that the true economic rent in the digital age has shifted decisively from validating blockchain transactions to hosting the heavy iron of artificial intelligence and enterprise machine learning. Through its strategic pivot, rebranding, and U.S. redomiciling, Keel has evolved into an industrial landlord of the digital economy. The company's core operational segments now center on owning and developing state-of-the-art data center campuses across strategic North American nodes, including vital locations in Panther Creek and Sharon, Pennsylvania, Moses Lake, Washington, and Sherbrooke, Quebec. Instead of merely burning electricity to mint digital coins, Keel's facilities, backed by secure power purchase agreements and brownfield energy assets, are being primed or directly converted to house high-density liquid-cooled clusters required by modern GPU architectures. Furthermore, the company maintains localized electrical and operational service divisions in regions like Quebec, providing an entrenched operational baseline. This shift transforms Keel from a cyclical commodity producer subject to the whims of token prices into a core infrastructure provider with long-term, high-margin, contracted cash flow potential mirroring traditional real estate investment trusts and Tier 1 data center operators. Future outlook, catalysts, and risks. Looking toward the multi-year horizon, Keel Infrastructure's growth thesis rests on its ability to monetize its 2.2 gigawatt development pipeline in an energy-constrained market. As mega-cap technology giants exhaust the readily available power capacity around traditional data center hubs like Northern Virginia, they are aggressively expanding outward into secondary and tertiary power markets where brownfield sites with existing high-voltage interconnections already exist. Keel's strategic footprint in Pennsylvania places it right in the crosshairs of major energy policy developments, such as Governor Shapiro's grid standards for responsible data center growth, giving the company regulatory clarity and preferred status for institutional-grade deployments. However, investors must weigh these formidable catalysts against distinct structural risks. The capital expenditure required to transform raw power assets and crypto mining sheds into Tier 3 equivalent AI data centers is immense, creating potential dilution or leverage pressures if financing terms are unfavorable. Moreover, execution risk remains high. Delays in hardware delivery, local zoning disputes, or sudden shifts in interconnection rules imposed by regional transmission organizations can push revenue recognition further out into the future. Despite these near-term friction points, the macro reality remains absolute. Compute demands are scaling exponentially, while power generation and grid access are moving at a glacial pace. Companies that legally own and control energized land with ready megawatts hold all the leverage. By looking past the short-term price noise, quarterly earnings volatility, and legacy ticker associations, patient investors can recognize Keel Infrastructure Corp. For what it truly is, an undervalued, power-backed infrastructure play sitting directly at the intersection of the modern energy crisis and the artificial intelligence boom.